welcome along to the Property Academy podcast by Opes Partners. I'm your host, Steve McKnight.
And I'm Andrew Nicol.
And for the show, we've got another case study Sunday, and we are so pleased to have Stacey and Matt on the show. Now, you guys recently came onto one of our Property Live webinars and shared your story, and people loved it so much, we thought we've got to have these guys back on for Case Study Sunday, so thanks for coming.
Thank you for having us.
Cool, so let's rip into it. You guys are doing quite a lot to get ahead financially, and property is just one part of that. What are some of the other parts that you do to get ahead with money?
So obviously we do a lot of saving. We talked about it last time. That's our biggest one at the moment. It's just trying to create a big buffer and then to be able to invest as much as possible and get as many properties as we can going on.
And how do you save extra? Are you cutting down on some of your costs? Are you not going out for dinner? What kind of things do you do proactively to save more?
Yeah, so every 3 months we do look at our income and look at what's changed and what our expenses and stuff are. In the beginning, we made sure that we rang up like utility places to cut down, see if we could get a good deal for things like that so that we could then put more money into things that we wanted to. And we just make sure that we have certain percentages going to things, but we want to make sure we're having fun as well. So there is entertainment and we do go out for dinner and stuff as well, but we're always wanting to kind of look for good deals and things like that.
And ballpark, how much are you saving of your income?
We're saving about 40% and we're hoping to up that up to 50 by the next 6 months.
40 to 50% of your net income?
Yep.
Wow, that's a huge amount.
Yeah.
And I know in about 2 days' time, we're going to record another episode where, Stacey, you're going to take us through your wealth system because you've got a specific way of doing that. But Matt, when we went out for dinner last time after our webinar, you talked about how you started with 10% and gradually increased it. Talk to us about that part of your system.
Yeah, so we help a lot of people with Stacey's system and stuff like that. And if you can start at 10%, you start at 10% and then you times it by 10. So then it goes to 11%, 13.1%, I think it is, and so on and so forth. So it's taken us good 4 years to get to the 40 to almost 50%. So it's not just a 20, 40, 60 kind of situation. You've got to get there gradually, and it's all about removing the emotion from the money.
And you guys are gradually turning up the temperature in terms of how much you're saving as much as you possibly can.
Yeah. And look, we will also like sell things. We're right at the stage at the moment where we really do have to look at upping our income because we've cut everything where we can.
Yeah.
Well, that's an important point. Now, we often say to people, you can't save yourself rich, but I suspect that maybe you guys can because you are some pretty serious savers. So why is it that you guys decided you wanted to add property into the mix and start investing in property rather than just continuing on being very successful saving?
Wow, it's not going to give you a return in the bank, really. Like, you're not going to get a good amount on that. We've always loved property, like Matt's growing up around property, and we knew that that's probably going to be the way to have a successful retirement. So we really wanted to look towards our long-term rather than focusing on our short term, and we thought property is a good way to do that because it's the thing that does go up.
And I'm really glad you guys brought up retirement because I know when you came on the webinar, Stacey, you were mentioning that your mum had just retired and you didn't want to have the same choices that she currently has. Can you talk to us a little more about that?
Yeah, so mum and dad split up quite young. I mean, when she was about 50, so she had to remortgage. But she didn't think about her retirement. And then, we think it's going to be ages down the track and then it's actually not. And then she was kind of forced to kind of give up work and then, hadn't thought about that next stage. So it just meant that she hasn't been able to have choices, like doing extra things. Yeah, she did have a house and so she was cashed up a little bit, but, it's still something that you're still having to think about. And, you don't know when that time bomb's going to go off, like as horrible as it sounds, but it's true. So, you've got to make that money last and there's nothing else coming in now that works finished.
And so for you guys, when you decided you were going to get into property, I know there were some hurdles there around actually getting the money from the bank. So you gone to a couple of brokers said, no, we can't help you. What were those hurdles?
So mainly because I had a business and didn't have, steady income coming in. So they wanted to see 2 years of income and my income was low. And Matt had gone into commission work. So they could only take 50% of his wages as well, which made up a lot of what our income was. But me being me, I wasn't going to take no for an answer. And I just knew that there was another way, because I obviously knew that, we were saving money, we could do it. The system told us where we were in our finances. I didn't want the income to be kind of a barrier. So I just kind of kept working to look at upping our income, keeping with the savings strategy. And then found, a good broker that was able to kind of work it in for us, really.
So actually getting to a point where it's just, there's a bit of time with that business income and with that commission income, was that kind of the main thing you needed, or was it that plus a combination of getting your income up and getting your spending down?
Time was a thing, but funnily enough, we had 2 applications going at the same time. One said no, one said yes. So yeah, time was a thing for a little bit, but then when we got it over the line, I just think that it was about getting a good broker, to be honest.
100% about
Who-
getting the best broker, and she got us 4 times the amount that the others could get us.
Who was your broker?
So thank you to Kathy from Opus, who recommended Michelle from Tag.
Oh, great.
So yeah, and again, we'll get down to it a bit later, but I think that was one of the good things about working with you guys and Opus, was the fact that we knew that you would have good people around you that have the same vision and the goal of getting people into, better financial position.
And do you know what Michelle did differently to get that higher number compared to perhaps the other broker you're working with?
I really think she just looked at our application and took like our strengths, and looked at what we were doing well, what our situation was, and then made it look good.
Yeah.
Highlight.
I feel the other 2 were cookie cutters. They just put the things into the thing and went, that's it, bad luck. Where she actually pushed and she wanted it to work for us. So
I think a good broker is always going to highlight your strengths to the bank and also say, this might not meet perfect criteria by the book, but these are the things that these particular customers are doing to show that they, or demonstrate that they can actually afford this lending.
Yeah, 100%.
And so what did you end up buying, and where was it, Matt?
so we ended up buying a 2-bedroom property with a garage. We made sure it had a garage, so it was a little bit different, in Surrey Street in Christchurch. We looked at quite a few different properties, and this one just worked out the best for us.
And compared to all of the other properties you looked at, how did you decide this is the one?
We like the area with it's in Linwood, it's Upper Linwood, we call it, and it's close to the new stadium and stuff like that, so it's quite close to town. We did look at a couple in Ravenswood and also Kaiapoi, but we like the feel of being in the city, and we feel like it would rent a lot easier. So
Yeah, and just for anybody who's not from Christchurch, some of those other areas Matt's talking about there are kind of like satellite towns out of Christchurch, but you guys wanted it to be kind of more inner city, more near some infrastructure that's currently being built.
yeah, I guess it was a bit of a risk factor for us. It feels like it will rent quicker and easier in the town to start with for our first investment property, and then we can get a bit more risky after that.
Yeah, and it's funny, Linwood's one of those really interesting areas. I did a development there last year, and we've actually recommended a lot of Linwood properties for investors. And because of its proximity to town, they just rent really quickly and rent really well, which is, surprising to someone from Christchurch, because Linwood was, one of those rougher areas historically while I was growing up.
Well, when Kathy did show us, I was like, no, we can't go there. But then we actually saw where it was, and we were like, no, that's the nice part.
Yeah, and it's amazing how different parts within a suburb can be quite varied in terms of demographics, but also, now that there's a lot of gentrification happening around closer areas to the CBD like Linwood, it is different to maybe the Linwood that you have in your mind coming from Christchurch, right?
Yeah.
And I think that's an important lesson for everybody listening at home as well, thinking about, wherever you happen to be investing in New Zealand, sometimes we do have perceptions about a specific suburb, and you might think, oh, God, when I was growing up, that was the place your parents told you not to go. But over 30 years, things can certainly change. And over the next 20 or 30 years that you own this property as well, things really can start to change.
And so what's your property journey look like from here?
We have our existing property at the moment. We're looking to do some renovations on that to add some equity to that, to go again. So we're settling this property in March, and then we'll probably try and save up a bit more savings, and then try and go again in a year or so's time. And we're also going to try and look at doing a couple of joint ventures with some flips and stuff as well.
Great.
Oh, I remember you saying that. What sort of flips are you thinking of doing?
So just adding some, doing some renovations and flipping and stuff, and we'll probably try and look at do it with my parents and maybe a couple other people, and then we'll probably have to go to non-bank lenders for that as well.
The great thing with flips is that can generate some cash flow, and then you can use that to pay down your own personal mortgage and then re-leverage against that and buy your next investment property, which is your long-term hold. You do those by yourself. You do the flips with partners, because at the end of the day, that's just a one and done transaction. You can move on to the next one, or you can decide that's it for us.
Yep.
Yeah.
Definitely.
And one thing people always ask us about is the dynamic in the relationship, right? Because often when we meet couples, they're on slightly different pages. They've got different roles in the relationship when it comes to money. Now, I know you guys aren't exactly the same. You play different roles. So what are those roles?
This is going to be my question. So yeah, definitely different roles, because we've grown up differently. Matt's parents built their houses and have done well through that. My parents, it's just not something they've even looked at. So Matt's kind of strategy used to be save, splash, but then also really risk averse in some way, whereas I'm really optimistic. And so I always have a vision, and I'm like, I'm not taking no for an answer, let's just do it. And so it really balances us out, because Matt's more of a researcher and kind of looks for the risks, whereas I'm like, who cares, just go for it. And so we probably move ahead because of that, but then we're not in trouble because of Matt either. So yeah, it works really well.
And now, Matt, I need to ask you, do you agree with that assessment?
Yeah, no, definitely. I'm the spender and the splasher back in the day, but now when we've combined our finances, it just feels more accountable, and definitely.
And one thing that I'm really interested in is you guys are really onto it with money. You guys, you're not done with your money. You're pretty smart with it, at least compared to the vast majority of New Zealand. You'd probably be in the top 2% of savers as a percentage of your income. So why was it that you chose to use a financial advisor or a property investment company like Opus Partners as opposed to going out and finding something on your own?
Because I think that you really have to put a good team around you, and choose people that's their bread and butter. And so this wasn't ours, and so it was still really scary, right? And so what's really helped us with Opus is the fact that you guys have literally stepped us through every step of the way. And it's, for us, it's been amazing how it's just rolled and how it's just happened. We started off hearing you guys talk, which then led us into a conversation with Kathy. We didn't think we were to be able to do it, crunched the numbers, got our mortgage broker involved, said yes, and then the house was presented to us, and here we are. So it just flowed, but I don't think we probably would have done it if we didn't have someone that's not emotional in it with us to be like, no, you can do it, let's go.
Just holding your hand,
Yeah.
That was the biggest thing, the step by step, getting the emails constantly and stuff, going, have you done this, I'm like, oh, yeah, cool.
And
So it
because
just
when
makes it
we
easy.
bought our first house, there was a private agreement, so we haven't actually gone through those things that you've got to think about. And even yesterday we get an email saying it's time to think about your finance now, because you're going to settle in a few months' time. And it's just so good forward planning and thinking, which we're like, we wouldn't be thinking about that now, even though that we're pretty good with our money. It's just something that we probably wouldn't think about. So the fact that someone from here has sent us an email going, okay, it's time to think about that, it's just helped take the stress out of it.
And if you guys had one piece of advice for other listeners of the show, what would it be?
Just do it. Honestly, just have a call. Just do it. Don't hold yourself back. Don't put that little voice that's telling you no aside. And yeah, just do it, because you won't regret it.
Right, let's wrap it up there. But please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And if you want to invest in new build properties like Stacey and Matt have, you might like to come see us here at Opus Partners. We could find the right new build for you guys. Thanks for listening to the Property Academy podcast. I'm your host, Steve McKnight.
I'm Andrew Nicol.
We're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time,